So I've posed this question to Sean Dobson so many times, and Sean has always said that what really makes people decide to buy a house or not buy a house, a huge factor is their monthly payment, Sean. And now we're in a situation where we've seen this unusual phenomenon of interest rates going way up, mortgage rates going way up, and prices going way up too in many, many markets, although not all. So what's going on, and what could justify this and prevent what we've usually seen under these circumstances?
Well, thanks for having me. And I'm not sure I'm the best source because I lost a lot of money on this in the last couple of years with interest rates spiking so much and home prices going up. But I think most of you probably ought to know the fundamentals of the story is that what caught a lot of us off guard, maybe just me, was that so much of the housing market is now locked up with these super low interest rate mortgages. So the float of homes fell about 35 or 40%, and in some markets a little bit more, a little bit less.
So you had the inventory.
So we think about I'm a math nerd at the end of the day, but we think about housing. There's the stock of housing, all the homes that exist, and it's upwardly floating a little bit, but not fast enough. And then there's the float of housing, which is that stuff that's for sale. And that float, with the homes listed available for sale, is down about a third, as you all know. And that's really a difficult thing to thaw because of something that's truly only American, the 30-year fixed rate, freely prepayable, and it turns out non-recourse mortgage. So these homeowners are enjoying really low interest rates for a really long time.
Right. And Julie, what do you see in the markets you're covering in terms of maybe some offsetting factors, low unemployment, rising incomes? Are they counterbalancing some of the pressures from higher rates and higher prices?
You know, we really thought that the multifamily rental market would be buoyed, right, by this lockup effect. But we have seen some of these inflationary pressures, impact our tenants. And so we have seen a little more doubling up than we'd expected. We also, frankly, delivered a lot of new supply on the multifamily side to many of our markets. So we thought the multifamily renter and the renter would be relatively strong, and rents would be relatively robust during this period of time because there wasn't enough stock to buy. And we thought that this new paradigm of the American dream, which is to try different cities, to move around to see where you fit best versus buy a home and live there for 30 years and never leave. We thought this mobility option would drive a lot of the multifamily rental market. And it's not as dire maybe as the office market, but the multifamily rents have been a little softer than we expected this year.
Right, and now we're seeing on the long end of the curve, rates go down in the last few days, some positive information regarding inflation, but we have really high real interest rates. And I know Sean is focused on this one a lot. You look at the TIPS rate, it's well over 2%.
Exactly.
And the equity risk premium is practically zero, and the whole story. And I'm wondering, and Sean, I think Sean's position has always been, it's just too high. Right?
Exactly.
Yeah. And so if it adjusts and goes back to a 1% growth economy, you're not going to have a 2.2% real rate, right? So that would help housing, wouldn't it, guys?
Yeah, I think so. I'll dive on that one. I think that real rates are about 100 basis points too high in our opinion, which basically makes mortgage rates about 100 basis points too high. There's another problem that creates an opportunity for us on one hand and a problem on the other. Mortgages themselves, the security of mortgages, the bond itself has become really under-sponsored. This doesn't get much coverage because it's kind of, geeky fixed income nerd stuff. But basically, pre-financial crisis, you had large inventories of mortgages held by the street and very large inventories held by Freddie Mac and Fannie Mae, and then large inventories held by the banks. Those three constituents are gone, and the mortgage market is lacking a sponsor. So mortgage interest rates, holding everything else the same, could be potentially almost 1% too high because of a lack of investor base.
Right. Julie, your view on what lower rates may, will they happen and what will they cause?
Well, I think the real story for residential and multifamily and single family for rent is that this new supply wave will ebb, right? And so we'll have a lot more opportunity to grow rents. But I do think that lower interest rates will unlock a little bit of mobility, maybe bring a little more housing stock back in the market, which should benefit some other asset classes like self-storage and retail.
Right. And we just suffer from such a dearth of new construction in America. We see some of it in the Sun Belt. You don't see any of it in places like New Jersey, right? The supply's been frozen forever. What needs to be done? For example, if you look at markets like Jacksonville, if there's new houses being built and coming on the market, it tends to have a very moderating effect on price increases. When you have a fixed supply, any jump in demand causes these huge spikes, as you guys know. What do you think could be done to improve this situation?
That's all you.
Yeah, well, we just saw a big law get passed here in New York, didn't we, which is trying to address that very thing. So how do you add more to the housing stock? But the reality is it's municipality by municipality, tax incentives, and whether it's conversion of office to multifamily, or it's the ability to remove some of the obstacles like in California to providing new construction, whether it be for multifamily, for single family. It is fortunately and unfortunately a municipality by municipality story, and that's where NIMBYism unfortunately has really prevented us as an industry and as a nation from providing enough housing stock, and certainly from providing enough affordable housing stock.
Yeah, and I think, Sean, you had a project involving the construction of very affordable homes, the manufacturing process. Can you talk about that?
Yeah, so yes, we're developing, and we're not sort of new in that. I mean, this isn't a new business, but we think that the key to unlocking supply in the urban core, and that may involve taking down some of the old toxic housing that's been around too long, is building the home either in pieces or the majority of the home in a factory and bringing it in and placing it. So these are the same construction techniques you would use on site, so it's just off-site construction. So we built a factory. We've completed about 250 projects. So we're just learning how it works. But I think that one thing to remember about the U.S. housing, the single-family housing stock, is that the development mechanisms in the U.S. are designed to build neighborhoods, and every trade is set up to go and build 10 foundations or 10 frames or 10 roofs kind of in a row. When the homes are ready to come down, the nation doesn't have a development infrastructure to go replace that one home.
That one home, yeah.
So that's what we're trying to build.
Right. And I know in California there's been a proposal to allow landowners with one home on their property to subdivide into 2 lots. Is there any potential there?
Yeah, so our headquarters is in Austin, Texas. Austin was very aggressive with its zoning, basically made single-family lots illegal. And that allowed people to put up to 3 homes on a lot. It's just now coming into play, and as Julie said, the city can pass the law, but that doesn't stop there. There's still neighborhood associations, there's other barriers, and they're not really sort of desirous of having their neighborhoods densify.
Right.
And it's this tension between the cities trying to create more housing and the landowners trying to preserve what their view is of housing is really the source of the friction.
Julie, who's going to win?
Well, I think when the tax revenues start running out, that's when real estate investors will win.
Yeah.
Because I think, you know, when tax revenues start drying up because you've had degradation in office, you've had degradation in retail, and people don't have an affordable place to live and they vote with their feet, that's when the pressure will come to these communities, which is, what are we going to do with these obsolete, vacant office buildings? What are we going to do with our affordability and our housing crisis?
So let's move on to the commercial side. Of course, the big news has all been about office. You mentioned perhaps the ability to turn office space into residential. That tends to be very expensive with lots of retrofitting. But you see great projects like the Hudson Yards that's totally new. KKR, all the big Wall Street firms have moved in there, JP Morgan. And that space seems to be highly desirable still. What are the areas or the categories in office that have been hit hardest, and geographically the areas that are hit hardest?
Sure. Well, you know, I'm here to tell you folks that the headlines are real for office. Now, office as a percentage overall commercial real estate represents a much smaller amount of the commercial real estate float today than it ever did. So think in the past, office used to be 40% of the value of all U.S. commercial real estate. It's now down to 20%. So it is meaningful, it is material, but we do have other asset classes like data centers, like single family for rent, like student housing that characterize the sector. But what's going on in office is truly, I would say, it's a century-long phenomenon, meaning today we have 18% quickly going to 20% vacancy in the office stock. That has never happened before
Up
in
from
history.
what, Julie?
Vacancy, so the worst vacancy we ever had is in the high teens, right? So 14, 15%, going all the way back to the 60s. So now we have 18 to 19% vacancy going to 20%, and that doesn't even include sublease vacancy, which is 2x of its historical average. And the winners, as you say, are the One Vanderbilts, the Hudson Yards, the new shiny office building that is the amenity that you use to attract your talent back to the workforce. You have your amenities on the bottom, you have your breweries and your restaurants, you have your pet spa and pet daycare in the middle, and you have your rooftop deck lounge on top. But those are expensive tenants you still have to buy. So to answer your question, what happens to the rest of the stock? Well, we can look for malls. The Class B and C malls is an example. I was driving up to Rhinebeck the other day, and you see these malls still by the side of the road that have weeds growing out of them, right? Because they have not yet been knocked down and repurposed. So a lot of these commodity office buildings are only worth land value, and they have to be knocked down and redeveloped because, as you said, this multifamily conversion is not a salve for more than 2 to 3% of office stock in the U.S.
That's kind of wild, right?
Right. So
wild.
Yeah. So where are we seeing pockets of good performance on the commercial side? And of course, Sean is an expert in single-family rental, and I know, Julie, you're also an investor in single-family rentals. That market has been very good, hasn't it?
Yeah, it's been great. Our demand side is the opposite of what you're seeing in most commercial real estate classes. And what I like to point out to people is that occupancy itself in the U.S. is up with population. It's just shifted. And all the things that we used to do someplace else are happening at home now. Everything from streaming and delivery and now working. We were already shopping. And so all of those things that we used to do sort of out and about in town, so many of them are just better experience at home. And when you took work into that equation, it really upset the apple cart, and I think it upset it permanently.
Right.
So on the commercial side, we see strength on the data center side. We have 2 years of astronomical rent growth, student housing, historically high rent growth in that asset class, and then modern logistics. So what most people don't realize about warehouse space in the US is the average warehouse is 40 years old. And guess what? The new robotics, the new stacking and racking systems that Amazon uses to distribute solar panels on the roof, battery storage to support EV trucking and EV fleets cannot be supported by the legacy stock of warehouses in the US. So we see particular demand and resilience in that asset class. So a lot of bright spots counteracting some of the office storm clouds that may be with us for a period of time here.
Want to hear an anecdote?
Yeah, please, Sean.
Fun. So we have a small business of lending to real estate redevelopers, people that buy an old office building, spruce it up, and then sell it at a discount. Or warehouse, whatever. So we financed an office building that was the headquarters for the Phoenix Online University in Arizona. The borrower, very sophisticated borrower, had a very sophisticated plan. When it was a single-tenant building, turned into a multi-tenant building. Pretty simple strategy. Did all of their CapEx, got it going, advertised it, COVID hit, nothing. They gave us the keys back, so we were non-recourse lenders, so they very politely said, we surrender, we give up. So they lost all their equity. We own the building about 55% of their basis, so we're like, we'll just cut rents and lease it up. Crickets. Couldn't find a buyer. This was a $50 million building in today's dollars. The structure was less than 20 years old. We're tearing it down, and we're putting back last mile logistics in its place. So we're taking down $40 million worth of improvements and replacing them with another $40 million worth of improvements. And it's exactly as Julie said, what goes back there has to have the right ceiling heights, the right dock heights, the right floor plan. So even the economy is moving so quickly that even that stock is a danger.
Yeah, but this was Are you replacing it with a warehousing or?
Yes.
Yeah.
We're
Okay.
taking a 300,000 square foot office to the ground.
Jeez.
And rebuilding warehouses.
Yeah.
And that's the solution for a lot of office. Unfortunately, many of these municipalities will not approve it. They don't want the truck traffic. They want their beautiful suburban office or their old retail center.
Yeah.
And so you've just got this tension between vacant buildings and municipalities
So
who
they
want something in there.
They won't allow you,
They won't allow you. They
developers
won't
to tear down
approve.
the buildings?
They won't approve your entitlements.
So
they won't approve your
I
permits.
have another one in Phoenix that's 250,000 square feet, a beautiful 14-story tower. And it's 50% occupied, and the other 50% has been on the market for 3 years. We went to the city and said, you know, when these tenants go, so does the building. and they said, no way. They said, when this all turns around, we need offices to run our city, and we're not going to take that thing down. So now we're like, okay, what do we do in the meantime? Because we still have to pay property taxes and insurance and maintain the building. But
Do you think what they're telling you is going to happen will ever happen?
I don't know. Will it come back? I don't think so. I think that work from home works. And I think that the 2-day or 3-day in the office work week is with us for a long time. We have, in Austin, Texas, we have a traffic problem not too dissimilar from New York's traffic problem, where we had people that were not in like super critical creative jobs, but critical function. The people that do payroll in our HR department. Someone's got to cut paychecks every 2 weeks. Those people were driving in an hour, sitting at a desk, working either by themselves or a team of 2 on something that wasn't super time sensitive, and then driving home an hour. Why make them do that?
Now, we know that a lot of this real estate debt is parked with the regional banks. And Julie, are we going to see a wave of distressed sales from the regionals? What's in store there?
So we've been waiting for this now for a little while, and it's finally starting to accelerate. Banks have realized they've got to cut some of their losses. They've taken some assets back. They've seen where the new values are, and so they're willing to be more flexible and a little more active on removing some of their exposure. Remember, we have Basel Endgame coming, which makes holding those distressed office loans especially so much more expensive to banks for hold and regulatory scrutiny. So I don't think, the Fed is saying, hey, friendly lender, work with your borrower, help with the blend, the pretend, and extend, yet that regulatory pressure is doing the exact opposite. Right. So we're definitely going to see some friction there as we move forward.
Well, thanks so much. We're out of time, unfortunately. We could go on much longer, but it's such a pleasure to see
Very
Sean
good to
and
see you.
meet
Thank you
Julie.
so much.